Fibonacci retracements. For those of you that don't know what it is, I'll give you a very sort of brief introduction. All right, it's an extremely popular tool in the financial markets. All right, there's an important sequence of numbers that go 0, 1, 1, 2, 3, 5, 8. And basically, what it is the last two numbers added together makes the next number. And the whole idea about Fibonacci, right, is that there's one particular golden ratio, right, which is the 61.8% ratio, which basically, allegedly, ties everything in the world together. So not just the financial markets, all right, but sort of like the distance between, it's like the ratio between your hand and your forearm, and then your forearm and the rest of your body, etc. So basically, it's a ratio that it's not just for the financial markets, it's a worldwide golden ratio. All right, it's like the perfect ratio. But unsurprisingly, it is used in the financial markets. There are other ratios that are also used. You've got the 38.2%, 23.6%, 50%, 78.6%. All right, and they're all also used in your Fibonacci tool that you will find on your trading platform. Now, to be honest with you, if we speak candidly, a lot of this, I'm assuming that at some point in time, at one point in time, someone looked at it and they found that these ratios had some sort of impact on the market. But as time goes on and as more people use it, it becomes more of a self-fulfilling prophecy. All right. But the way that we use it isn't necessarily to draw lines all over our charts, although we do that. But once you've had some experience with the markets, you tend to see what a harmonic price action looks like. All right. And we only want to we basically trade in the direction of the trend because that's what we find most profitable. And we trade pullbacks in the trend. But where we're different to other people is that we don't just trade any pullback that you see. It needs to be a pullback within these ratios. Okay. So the pullback needs to be sort of at least 40% ish of the previous trend move, the previous momentum move, in order for us to consider taking it. If it's not that, then we're not interested in taking that trade. Now, that retracement could be, a complete reversal of the trend, or it could be sideways price action. Don't really care either way, as long as we see a period of consolidation, a period of pullback that's more than just a few candles. All right, and this is where this will really help you use it in your trading. So as I said, charts harmony. The market works very well with ratios. All right, that's why Fibonacci trading can be so successful. All right, but to trade successfully, you must start to develop an understanding for how ratios work in the financial markets. Most momentum moves in the markets, up or down, are followed by a proportionately measured pullback or consolidation phase. You never see the market move from point A to point B in a straight line. There are always peaks and troughs in the middle. Am I right? Has anybody noticed this phenomenon in there? You just type a yes or a no. You notice that the market never goes from A to B without pulling back in between. You have. Excellent. Or one of you. So basically, we do not measure the size of the retracement to derive an ideal pullback location. We also measure the length of it. And I'm going to make that clear now. So if you look at this particular chart here, you'll see that we've got a series of moves to the upside. So the market moves up, it pulls back, it moves up, it pulls back, it moves up, it pulls back, it moves up, it pulls back. Now, what I want you to notice is how each one of those moves, each momentum move, okay, occurs after a pullback, a measured pullback of about 40% of the previous move up. Now, that can either be to the downside, all right, so we can either have a complete reversal, or it could be sideways price action. But the point is that the good moves in the market, the markets that make you money, occur after a pullback, after a measured pullback. Now, this is very difficult for new traders because They want to be in the markets no matter what. They're not willing to be patient enough to wait for those moves, to wait for the right moves that are going to give them the highest probability of success. They just want to get involved in anything. They don't really care either way what that is. They just want to be trading anything. Do any of you identify with that? Have any of you ever sat there, looked at a massive move in one particular direction, and then sat there and thought, oh, I really want to get involved in this? The market starts to pull back a little bit. And once the market's pulled back, just a tiny bit, you look to get involved in the trade, even though the trade isn't right at that particular moment in time. Yeah? And then you get into the trade and suddenly the market moves against you. Okay? You get stopped out of your position. You're cursing. You're basically, you've lost money there. You're not happy. You say that you're not going to make that mistake ever again. You're not getting involved in the pullback. Maybe the system you're trading, you don't like that. Any number of things. But ultimately, you've gotten at the wrong place. The market takes you out, and now you're frustrated. You then don't get into the next opportunity. All right? So it pulls back a little bit more. Then it gives another opportunity to go long, for example. You don't get involved in that. And now the market shoots off in your direction. Who's been there? Stop reading your mind. I know. But the reason for that is that you're not waiting. You guys and girls, if you're on the line, you're not waiting for the right pullback. You see the momentum in the markets and you want to be a part of that move. You're not waiting for the market to come to you. You're scared you're going to miss it. You see all of those pips on the table, all of those points there that you could have taken from that momentum move, and now you're scared, stiff. The move for the day is gone, so you need to get in no matter where it is. You're not willing to wait for it because waiting for it might mean that you miss the move because the market might not stop. And maybe if you wait for the pullback is just a reversal, right? That's what we all go through as traders. But you need to understand that there needs to be harmony in your charts. I promise you, if you can just take this one thing away from you about looking for harmony in your charts, your results, your profitability, your consistency will improve like you have no idea. So just take that one thing away from you, to look for harmony in your charts. Every momentum move in a particular direction needs to be followed by a measured pullback of at least 40%, right, of the previous momentum move. That's why we're not interested in this little pullback here, because that pullback there, that's nothing. We're interested in the major pullback. After a major pullback, you've got a much better opportunity to get into the market at bargain prices.